and welcome to our FX and rates outlook for 2023. Over the last 3 months, investors have navigated a number of risks. More recently, the US regional banking crisis has cast a shadow over growth prospects as well as the future of monetary policy. The uncertainty continues in the system, and as we see it, there are three major questions that face investors today. The first is the global economy going to see a recession? And if yes, how severe is this recession going to be? Now, global growth is expected to slow down to about 2.8% this year from 3.4% last year, according to the IMF's latest forecast. If we look at the US and looking at the US yield curve inversion, it does suggest that the US economy is expected to move into a recession in the coming quarters. However, recent macroeconomic data suggests that the economy might be stronger than what was earlier anticipated, and therefore a soft landing is not off the table just yet. Even in the event that there is a recession in the US, we think it is likely to be one that is shallow and brief in nature. Across the Atlantic, the outlook is supposed to be less sanguine in Europe, with major economies like the UK as well as Germany now expected to see a contraction. Across the globe, EM Asia will continue to be the bright spot led by China. Now, it's true that Asia is unlikely to be immune from the global growth slowdown, and exports are expected to be a drag. However, the high dependence on the domestic economy, moderating inflation, and better macroeconomic fundamentals could cushion the impact for most emerging Asian countries. The second issue is around inflation as well as the future path of monetary policy. There are initial signs that inflation is peaking across advanced countries. As the impact of past rate hikes filters through the system and service activity moderates, inflation is expected to decline through the year. Going forward, we expect the Fed to pause after another 25 bips rate hike in May, and the ECB could stop after another 50 basis point increase during the summer. The bottom line is that central banks are at the end of their rate hike cycle, and bond yields seem to be close to their peak now. However, in recent weeks, investors have been very quick to price in that the Fed might cut rates this year. We think these expectations might be premature as core inflation remains elevated and headline inflation is expected to remain above the central bank's target even by the end of this calendar year. Lastly, what does this all mean for EM assets? Overall, better growth prospects and the China led optimism makes a case for renewed interest and carry flows into Asian EMs. With some moderation in the dollar index from current levels, EM currencies are expected to see gains. For India, we expect the central bank to keep rates on hold at 6.5%. Bond yields are likely to edge lower through the year, and the yield curve is expected to steepen from the current levels. Although nominal interest rate differentials with the US are likely to rise as US yields decline on rate cut bets. We see both portfolio and FDI flows to remain in the green and provide some support for the rupee. In terms of other macroeconomic fundamentals, we see the current account deficit reducing through the year, which should take some pressure off the rupee further. That being said, we expect the RBI intervention to continue and keep the rupee range bound, therefore preventing both sharp appreciation as well as depreciation pressures going forward. For further detailed analysis, please do take a look at our FX report. Thank you for listening and have a good day.